First rates, Monday morning, we start a brand new day, a brand new week, and the first rates will just start kicking in. So I'll start measuring the rates when they start coming up on your screen. It's a truncated week, folks, but it's a good start. The breadth, I think, has been the most enviable part if you've been missing out the rally, but that's also been the most joyful aspect if you've really participated. Bank Nifty not off to a great start. Small cap indices, they're doing the best, which is that they continue to outperform. You want to shift gears and talk about Tata Steel, stock in news. I don't expect a big move there, but in terms of a rub of red, well, there is a rub of green there, I beg your pardon. Then look at banks, PSU banks, Union Bank. Let's look at SBI, BOB, UCO Bank. All that entire banking cahoot is off to a great start. Throw in some of the defense names now. You cannot miss them for long. Throw in all the railway names one by one. You cannot miss them for long. And last but not the least, you've got names like Zomato, Paytm, Defense, just about everything in the space. I think it's looking very, very charged. Anisha?
Well, yes, so apart from defense and the PSU banking names that you talked about, telecom is also doing cartwheels. So Vodafone Idea continues the up move for whatever it's worth. 12 bucks a piece, but nonetheless that stock is high by 6%. Indus Towers seeing a surge of almost 3%. And then you have the power and power ancillary, especially the green energy one. So Adani Energy, for instance, Suzlon, Triveni Turbine from the broader markets. These are some of the names which are perking up, but not a big trend that we are witnessing right now, apart from the fact that it's of course the mid cap and the small cap space which is outperforming. But other than that, not a big sectoral move coming in. In fact, all the sectors have started in the red, with the biggest laggard being IT. Infosys is already down 1.25%. Persistent, HCL, Tech Mahindra, they're all seeing quite a bit of profit booking. So these are the stocks in focus. But let's take the first rates from our chartist.
Absolutely, we'll do just that. And Naresh, what is it that's catching your eye on the screen with a healthy market breadth, a bit of a follow through but a quiet move this morning?
So looking at UPL Limited, the stock seems to be bottoming out at 625, 630, an entry point for the short term.
Right, that is Naresh's first take. It's a buy on UPL. But Nikunj, we love having guests in the studio, and today you're going to pick Atul Suri's brains, I guess.
Hello, sir. Good morning.
Morning, sir.
How are we doing?
We are good. We are good.
No one can complain in this market, right?
Yeah, I know. Can't complain actually.
The one who not participated, which is a big crowd actually, they are complaining a lot. They are calling it like too fast, too quick,
too expensive.
Too expensive.
Ignoring macros, like Anisha said here.
What is the right way of looking at this market? Stay with the trend because trend is your friend.
Absolutely. I mean, that's something we've been speaking about. And see, at the end of the day, we give targets. Okay, I give some target of X, Y, Z. The target's not important. The important part is the direction. The important part is, are you invested? And I think there's a strong case to be invested in India. You'll realize that whether you see globally, let's take it globally, India is probably the only market at lifetime highs.
Yes, we discussed this last time.
Okay, fine. Number two is you go into the sectors. You look at the market breadth. You'll find barring IT per se, every sector is 2 to 3% from lifetime highs.
Yeah.
If you see market breadth on a 52-week high, 52-week low basis. So I think that, one, you really cannot fight the trend. What is expensive, what is cheap is very subjective. We can discuss about P's and what should be the correct P's forever. But the fact is that the direction is up. My job as a fund manager is ultimately to have stocks that are running faster than the market, and that is how I will outperform and the clients will outperform. So actually spending too much time on where the market is, when after seeing so much evidence, if you still have doubt, then I think it's a question of belief. And that is something which I've learned from Rakesh ji over the years, that the biggest wealth creators, I have seen people around him, one thing is common, they've had belief in India, and even through all the corrections that we have seen, they were invested. Yes, they experienced pain. Every investor will experience pain. But the fact is that do you believe or you don't? And when the numbers in the markets and all the statistics we put out are showing you so, I think the question is that am I in the right stocks?
Atul, in the moment of despair, which is somewhere in the middle of last year, when markets were puffy duffy, you said Nifty 21,500.
Right.
Now what looked like a very tall number, a higher watermark number, we're almost there.
Right.
So time for you to even take your levels higher now?
I was so expecting that question.
He said don't focus on the targets, focus on the direction.
Exactly.
21,500
No, so with due compliments, I mean, Atul was the only guy who talked about even 20,000.
Yeah.
And 21,500 that time more like a very high watermark number.
Right. See, the thing is that it has always three stages I have experienced. That the first stage, when you say people laugh at you, there's disbelief. There's general laughter. I mean, they'll be polite on your face, but after this, you heard what this guy, he's crazy. I don't know what he smokes. Then is the second is the case
You
where
don't smoke what?
I don't smoke. What do I drink? So the fact is that then you get a stage of acceptance. Once we broke 19,200, we made a new high. Then it was, oh, okay, fine, it's possible. And then you reach a stage when people say, bas itna hi. What else? Stretch it. So I think you go through these stages and you realize that the first thing I said ultimately is the direction. See, you and I, we are not buying the index. We are buying stocks. The important part is, am I in the right stock? I'm in the right spaces. Am I in the right sectors? And I think that is very, very interesting. The index is not really showing the actual bullishness of the market. The reason is that if you see the two biggest components of the index, one is banking and second is IT. You'll find that actually they have muted performance. So if you really sort of adjust for that, you will find that the market is like way beyond. The Nifty is way beyond, because the components per se, the broader market is telling a different story.
So there is no bubble, there is no euphoria, there is no overbought conditions according to you in the market.
I feel that for me the red flags, Nikunj, are global. What is concerning me is the way commodities have been going up, especially crude. And energy is a very big inflationary impact. You're seeing that in US bond yields, you're seeing that in the US dollar. So I feel that the risk to our Indian markets is more global, and that will get expressed by if you have a global kind of correction happening or you have aggressive FIS selling. Per se, if you look at Indian markets, you forget this morning or tomorrow. But if you look at charts or if you look at statistics, you really sense that bubbles, honestly, nobody ever knows. Nobody ever knows. It's only in the future someone say, oh, that was a bubble and it was obvious. It is never so obvious. If it was obvious, there would never be a bubble.
One thing which we are talking about, our dear old friend Rakesh Junwala, late Rakesh Junwala, he always made an important distinction. Crisis bol ke nahi aata hai. So if you are, all of us thought in 2021 and 22 inflation is going to be the bugbear.
Yeah.
With that kind of an inflationary environment, markets can never go up. But everybody knew inflation was coming up. So similarly, this entire crude impact in terms of moving from 85 to 90, 90 to 100.
94. Yeah.
94, I mean,
Brent.
yeah. So look, it's not a great situation.
Yeah.
But will this trigger the market collapse? That's what we're discussing. I don't think so. Right, Atul?
See, globally, I feel, Nikunj, sooner or later will have its impact. The difference is that India has stood out. As we are talking about global statistics, the domestic investor has emerged as an amazing force. Yeah. Last year also, if you see, global markets were off. I remember sometime in October or so, the S&P 500 was making 52-week lows. And we were near 52-week highs. In my life, I have never seen such situations. I have never seen such, and people said, oh, this decoupling is all bull, humbug. You know what happens when decoupling happens? We get thrashed. Ultimately, what happened? Those markets moved up to 52-week highs and we moved to lifetime highs. So in that sense of the term, it is true that, markets are cyclical. They have a way of surprising you. Who thought that commodities, we'd be talking about commodities? But I think the big danger point for global markets and markets in India will have a knockdown effect is commodities.
And who'd have thought as well, Atul, that PSUs would be where they are? My alert just hit the inbox that it's at a record high for the PSU banking index.
Right.
I know you were talking about majority of the index being close to their record highs, but are you surprised by this move?
Yeah, I think the surprise is the follow-up. Last year was a great year. In fact, the PSU banks were the best performing sector. And this was after a decade of underperformance. I mean, it was the most hated, shorted space in the world. In India was actually PSU banks.
Yeah.
I mean, the trade of the decade was long HDFC Bank and short SBI. When it turned, what's surprising me is that after a phenomenal 22, they're also having a very good 23. And that really shows that, yes, when decadal trends change, it doesn't end in a year. It actually gets elongated. In fact, the whole PSU basket, if you see, it's not just banks, it's defense stocks. It's a lot of these, infra kind of plays. These are like everyone, people who've been in the market for 20, 30 years have sworn we'll never buy PSUs. Because many times in their life they tried and they burned their fingers. They've given back 40, 50% drawdowns that have happened. And the market has again ways of surprising. So I think going with the trend, being humble, accepting what the market is telling you, that's what I have learned. So as Nikunj said, the trend is your friend. until the end when it bends.
That's a good one. But the trend right now also seems to be this entire rally in defense, capital goods, manufacturing, railways.
Right.
Do you think there also you just stick with the trend, or is it getting a bit concerning? It's time to kind of maybe take chips off the table?
See, obviously the price movements have been phenomenal, and you know that kind of vertical moves generally don't sustain. But the issue is that, first and foremost, as we just said, when things have not moved for 10 years, and then they start making new highs or lifetime highs, these things will not fizzle out in 6 months. They tend to be elongated. Yes, the short-term run may be large. Yes, they may correct, they may shake out. There's a lot of retail and a lot of, like we had that last week, I think one day when there was a broker report. Yes. Stocks fell 5%, 10%. But these things are very, very important, because if they don't correct, then very often it ends very, very badly. So I, for one, would be actually happy if we see some correction, consolidation, because you cannot have these 90-degree moves. 90-degree moves, a 200, 300% move in a year. Those tend to be concerning. We've seen they don't sustain. But I personally think that this whole PSU thing, etc., is a decadal shift. There's a decadal shift in sectors and themes. Engineering, infra, construction, these guys never moved post 2008. It was a decade that is lost in all these. So I think that when they move, they tend to be rather sticky. We've learned this from 2003 to 2008. We had a similar set of sectors that were moving. Similar themes were playing out. And that was a phenomenal bull market. And it kept surprising us. We kept saying, oh, it's too much. But ultimately, it lasted 5 years.
Look at what we saw, let's say, in a Page Industries or a Shree Cement, or I think in MRF.
Yeah.
2008 to 2020, those were the stocks which moved from 2-digit to 3-digit and 3-digit to 4-digit and 4-digit to 5-digit.
Absolutely. Yeah.
So are we looking at that kind of an action in PSU banks?
It's because that's what I saw between 2003 to 2008, Nikunj.
Okay. So
you'll find that similarly a lot of these stocks which were considered engineering, boring,
the backbenchers.
Yeah, because in 2000 we had an IT bull market, and I remembered all these things got smashed and nobody wanted to touch. A friend of mine very well put it, he's saying, जिस company में से धुआं निकलता है वो नहीं लेने का. That was IT bull market. And then what started between 2000...
IT में से कहाँ धुआं निकलता है?
जी जिसमें से नहीं
निकलता है वो नहीं लेना. So power and other things
you don't buy anything जहाँ से धुआं निकलता है.
जहाँ धुआं निकल रहा है वो लेना है. Railways, power, everything.
He put it very nicely, and then it did very well 2003 to 2008, and then those things didn't do well, and as you said rightly, there was a very narrow market. It was a very, very narrow market post that right up to 2020. Those few quality stocks, whatever, buy at any price. And then again, the trend has changed. So I think the market has a way. And I have noticed that our ability to predict the long future is very, very limited.
Think about it, ITC also. धुआं निकलता है.
बहुत धुआं निकलता है. बहुत धुआं निकलता है.
Right? I mean, why didn't I listen to this earlier, and I would have made like big money?
Okay. Now, which are other decadal trends which you think are about to peak out?
Okay.
That is also important, right? What not to buy. Recency bias tells us that you buy something which has worked in the past.
Right.
So when it comes to a decadal trend, you'll always be looking at private banks, you'd always be looking at IT.
Absolutely.
So it's important to avoid also, right? So
right.
Where would you avoid?
So I don't know decadal avoidance, but what is concerning, which I said, is the price of crude. And we know that it's a very big input for a lot of industries. So you'll find a lot of stocks which have done well in the past, whether it's paints, chemicals, agrochemicals. You'll find that their input cost will really go up if crude sustains at these levels. And I feel that again, like how last year a lot of them got derated, we could be in that kind of situation. Again, these are great companies, they will do very well. I don't know decadal trends on the negative side. If overall you see a market up move, everything will participate, everything will hopefully make money. But yes, for me, the concern for the next quarter is going to be these kind of spaces or sectors that are going to kind of play out. One sector I would just say on the positive side, which we find we've suddenly gone overweight in our portfolio after almost 2 to 3 years, is pharma.
Okay.
So we post I think post COVID, pharma stocks actually didn't do well. The trends changed. That was the highest overweight position, and they all got trimmed down. But I am finding that in the last 2 months or so in our PMS, we've actually gone overweight pharma after almost 3 years. So I feel that
Healthcare names, diagnostic, manufacturing.
Not diagnostics, but I think there are some which are the actual pharma places. They are a lot into exports. We sense that the pricing pressure in the US is kind of decreasing. And yes, healthcare, there are some hospital stocks. I think that is something that is phenomenal. That could be genuinely a very, very long-term, great compounding story that is playing out. So we are in those kind of spaces. But that is surprising because that's a sector that's less talked about. It is not, the kind of rah-rah sector. But I think that pharma is actually shaping up very good. You'll see a lot of the pharma stocks, which have actually not done well for years and years, have pushing towards lifetime highs. And that I think could be, again, something that has not done well for very long. When it starts pushing to 52-week highs, lifetime highs, you know that something big could start.
Could that apply to two-wheelers now? Bajaj Auto, Hero MotoCorp, the decadal underperformance.
Absolutely. Look, the electric plays.
Yeah.
That's again, auto is a very interesting theme. Again, an overweight space. What I found was that through our process, you realize that this whole electric side of the play, wherever, whether it's ancillaries, whether it is even these end plays. I don't want to talk about names specifically.
You can, it's okay.
It's okay. We'll avoid it. We'll discuss coffee. But the fact is that you'll realize that a lot of these things, which have an electric touch to it, and that is not just in India, it's global.
Yeah.
So I feel that if you are able to, even in auto ancillary is even more interesting. If you are able to segregate that electric place, I feel that there's a very, very big play out happening. There.
Would that weave into manufacturing as well as a theme?
Manufacturing, definitely, capital goods, engineering, they are, the domestic playing themes are actually kind of shaping up very well. Yeah.
Atul, we may feel excited about the SIP, we may feel excited about the number of demat accounts opening, but the sum total of the Indian young population versus what the actual reality is, 90% of the Janata has still not participated.
Right.
They are now looking at coming rather seriously.
Right.
So what would your advice be for somebody who says, okay, I'm impressed with Atul Suri, I like what he's just spoken on ET now, but where do I start? How do I start? There is something called law of gravity, which could be at play. So how should a first timer start?
So whenever clients approach me for that, I said, what, are you ready to lose 10%? If you're not ready to lose 10%, please don't enter the stock market. If you're ready to lose 10%, the moment is now.
Okay.
It is never, in our market, we've had so many corrections. We've seen it here. Now, we have been in the markets for so long. We've seen, we saw the COVID fall. I mean, that was like scary as hell. Yeah. Not just at the market level, at a personal level. Because you couldn't quantify it. You couldn't quantify it and see what happens. We don't even talk about it. Yeah. We don't even talk about
Ukraine, forget COVID.
Ukraine, a war in Europe, again a multi-decadal event. So the fact is that if you're ready to lose 10%, then the time is now. If you're not ready to lose the 10%, probably the time for you will be never. Once you understand the nature of equities, that hey, this is a game where hopefully you get higher returns. The reason you get higher returns is because the volatility is highest. The fact is it goes, risk reward goes. I mean, the investment with the least amount of volatility is a fixed deposit because you never have a single day of drawdown. But the fact is that that post adjustment for inflation, it is actually degrowth of money. So if you're ready to lose 10%, the time is now. Who knows?
But even with this mammoth move that we've seen in the mid and the small caps, you believe that the direction or the undertone is positive, it's not looking frothy?
See, there are pockets. There are definitely pockets. As I said, 90-degree angles don't sustain. So there are going to be pockets, there is going to be pain, there will be corrections, but they have to come. That is a process. In every bull market, everything is never perfect and kosher. And then that's our job. We have to be really smart that, hey, which of these are actually backed by fundamentals? If they're backed by earnings, backed by fundamentals, yes, they'll correct, but they will not crap out. So you have to be sensible. Now, just because everything is moved, you go and buy any two-digit stock, that's going to be a problem. So that is the job, I think, of a professional. That is where we come in. Ultimately, in a bull market, in fact, very often a novice may make higher money. But when markets correct, that's when, as the famous buffet line, it's when the tide turns, who's swimming naked. That will actually show out when the market's correct.
And yes. Just before I let you go, I wanted to ask your view because last time I spoke with you, you told me that you had those contra underweights which were large cap banking names and large cap IT.
Yeah.
You're sticking with that or any change in your stance there?
See, it's not I'm not short or anything of that sort, but at the end of the day, you are overweight some sectors, underweight some sectors.
Still underweight large cap banking names, private banks?
Private banks and IT. And I'm overweight engineering, electrical equipments, defense plays that there are. So I think that those are more interesting spaces. Yeah.
So before we wrap, let's divide it into three buckets: short term, medium term, long term. What looks good in the short term? What looks, when I say short term, 6 months,
Yeah.
medium term 1 to 3, and 5-year plus.
See, in the short term, I would not take it 6 months, but I think the concern for me right now is the way commodities are moving, Nikunj.
Okay.
You know, this could see a bit of an accelerated FI selling if the dollar spikes up. We know, and then at the end of the day, you know, it may not be such a pretty place to be in. So actually, in the short term, I feel that we could be. I think medium term, you know, the targets I've been talking about, that would play out. But longer term, what makes me very bullish is the nature, the composition of sectors and stocks. The last time I saw such sectors move, such stocks move, was a case where you saw an industrial revival. When an industrial revival moves in, the length of the rally and the stickiness of the rally is much, much longer. And if that plays out, then I think that we are in a very, very early stage of a bull market, which to many seems like, oh, but then that is the nature of the market. The markets will correct, they will disappoint, they'll do everything. That's the nature of the market. But the fact is, if you have your head held high, if you are optimistic and positive, I think at the end of the day, if you're in the right stocks, you will make money.
Well, always lovely to have you. Thank you for
very
joining
much.
us. And you know,
Continue your artwork.
Atul and me, every time we meet, we just say something Saturday ko milte hain.
Does that ever happen?
Stocks come out on a Saturday.
No, the point is the second part is we've not met only. With family and as friends.
Yeah, I know.
So I think now that we've discussed on air, we must make it happen.
Yeah, I know.
By the way, this Saturday ko milte hain. Okay. Let's look at markets right now. And what do we have? We've got a little bit of a nick actually on for benchmark indices. Just a bit of a nick. It's not like, you know, you're picking up weight from where you left. But I think the nick is clearly visible in the bank Nifty, in the small cap index, in the mid cap index. Look, markets are due for consolidation. The small cap index still in the green. So a rub of green, I think, is clearly visible there. What do we have? We've got a little bit of here and there on pharma, a little bit of here and there in banks, some auto stocks here and there, but just a lazy market. I think a lot of folks have taken the long weekend.
Yeah, Ganpati, right?
Yeah.
I'm sure a lot of people are busy, and you're talking about holidays. I can see that move on Ease My Trip. Maybe it's the rub-off impact of Yatra IPO, but that stock is high by actually 6%. Let's pull up that. Doing quite well for itself. So maybe people are booking those holidays, maybe on account of the long weekend that has gone by, or planning their year-end trips already. But yes, that's the stock which is making a big move, because other than that, it's PSU names, IOB, UCO Bank. These are seeing quite a bit of move. Bank of India. So that move that we saw last week actually on the PSU banks, that's really continuing, and that's the key theme in the market right now.
Absolutely. Let's connect then with Gautam Duggad as well, who's right here with us in our studios. Good to have you. We were just chatting with Atul Suri, who said that the target is not important, but the direction is. Are you going to give us a target, or also just give us that?
No, as a house, we never have an index target.
No, so just give us a sense as to what you're making of the markets right now. The fact that we have managed to outperform, despite the fact that there's been FII selling. Where does India stand, and what's the trend looking like?
Actually, FIs have been buying this year, right? YTD, they've bought about $16-17 billion. Domestics have bought $14 billion. So YTD, you've seen CY23, $30 billion of inflows already. As far as setup is concerned, see, India is the only market right now where I think both macro and micro are firing in good combination, right? With about a 6.5% GDP growth, inflation having peaked out, rate hikes behind, currency by and large stable, and external balance also in fine fettle. And you add to that the 30% sort of growth that we saw in FY22, or rather 38. On top of that, you've seen 10% earnings growth in FY23. And this year we are building in about 20% growth, out of which first quarter itself was 32%, and we have seen an earnings upgrade. So remember one thing, I think last 3 years, markets have compounded 27%. I mean Nifty earnings have compounded 23%. So in a slightly longer period of time, if you've seen, markets have broadly respected corporate earnings. FY10 to 20, when our earnings were lackluster, 6.5% compounding, markets gave you only 8.5% return. Last 3 years, 23% earnings compounding, markets compounded 27%. And this year we are talking about 20% kind of a returns. Yes, mid cap and small caps have rallied 28 to 30% on a YTD basis for CY23. But if you see the compounding again for Nifty, while much is being made of 20,000 as a milestone, the 1 year, 5 year, 10 year CAGR for Nifty is just about 11 to 12%. Which is nothing unusual, you know. This is the kind of nominal GDP growth you would have seen in the last 10 years. even if you look at mid cap and small cap indices, till about June 23, the 5-year CAGR or a 6-year CAGR for mid cap was 12% and small cap was 6.5%. Last 3 months might have made it look slightly better than what it is. But yes, some pockets are overheated, no doubts about it. But to basically brush the entire market as overheated or sort of speculative, I wouldn't be in that school of thought.
So do you need that 50% 1 year before you peaks out? Because historically that has happened. 1999, 2000, you got a 50% Nifty or benchmark return, then it peaked out. 2007, I think, was a 30-40% return, then you peaked out. Do you need that one big explosive year which could be a precursor to when markets will peak out? Because we've not had that explosive year at all.
Well, if wishes were horses, I would say it should never happen.
Of course.
Should keep getting about 15-20%. Look at it this way, Nikunj. This year you've crossed 20,000. Nifty is up about 11-12% YTD. And two big components of the market, which is banks and financials and IT, together make up about 42% of the index weight. 27% bank, 14-15% IT. They haven't really contributed, especially the large cap private banks. And without two big chunks of the market not contributing, Nifty is already at 20,000. What if this two components starts contributing? Let me give you another historical data. 1999 till 2019, you've seen 5 Lok Sabha elections, 25 years.
1999
to 2019, 5 Lok Sabha elections.
Lok Sabha elections, yes.
Every election, that is Lok Sabha election, 6 months prior to the announcement of election results. So election results are announced in May. Let's say 6 months prior to that, that is November to May period of this 5 different Lok Sabha elections era. Markets have given you positive returns, 10 to 32%.
Yeah.
Right?
The
best returns were in 1999 and 2009. Of course, every period has its own contextual nuances, but history is in favor of a pre-election rally, which is the period you will enter in another month and a half. And so far, if you go by the pre-poll surveys which have come in, last 15 days, we have seen about 3 pre-poll surveys. They are all pointing towards continuation of the current regime. If this sort of sentiment gets bolstered as you move closer to December, January, I foresee another leg of a rally, while everyone who's looking at things fundamentally, including me, will keep trying to make a sense of valuation versus growth versus fundamentals. But in the short term, 5-6 months, there is always a possibility that market disregards fundamentals and moves on something else, which is a big political event or a big macro event.
So if I put a flash out saying the Gautam Dugar, Motilal Oswal Securities of the view that we are entering a pre-election rally season for next 6 months.
Yeah, that's what historical evidence is. I mean, the data is there for everyone to see.
But what were the valuations like when these rallies have happened in the past? Because that is also important for us to put into context, right? So when these rallies have happened in the past, what were the starting points 6 months before the election and now?
So yes, valuations were very different at different points of time. Like 2009, if you see, it coincided with an era to October, November 2008 to May 2009. You remember we were coming out of that GFC
The base was very
market.
different.
That time the valuations were very different. In fact, that's the only period where markets rallied 32% 6 months prior to the elections and 35% 6 months after the elections. Valuations were slightly expensive in 2014 period also. Because with the announcement of the current Prime Minister as a Prime Ministerial candidate for BJP in September 13, I think the market started taking a turn from September 2013. I think in their Goa national meeting they announced. Right? 2019, obviously, we were right there in the zone. That's why the pre-election rally was just 10-11%. Today, as we speak, we are at 19 times 1 year forward, which is about 5 to 6% discount to 10-year long period average. Right? So despite the rally, you're not trading in a very expensive zone as far as Nifty is concerned. So large caps are a very different kettle of fish. And large cap Nifty, if you look at the total market cap, is about 157 lakh crore or 157 trillion rupees. Mid cap index, which is roughly 43 trillion as of now as we speak, NSE mid cap 100, that index is trading at a 16-17% premium to Nifty as well as its own historical averages.
So in dollar terms, and Anisha, just to have a follow-up question on this, let's say India's market cap right now is about $4 trillion. Broadly.
3.5, 3.6, somewhere about.
3.75, about one time GDP ratio, right? So let's say 3.75. How much of this market cap is right now trading below the average, and how much of the market cap is above the average?
So if you look at it this way, I mean, for
Just a
a
very
simplicity
basic, yeah.
purpose, just use Nifty 50 as a benchmark for your large caps. And I said Nifty is in line with its long period average, maybe 4 or 5% lower than long period average. And Nifty is roughly 60% of India's market cap.
Okay.
Right? You add another 5-6% because there are a lot of large companies which are not part of the Nifty, which are recent listing of last 2-3 years. So I would still say 65% of the total market cap is still either in line or slightly below long period average.
It's a great point. Market sasta hai.
Secondly, a lot of times we keep getting carried away because 20,000 is a new level and a big milestone. That market is at a new high, market is at a new high. We've never seen headlines which says corporate profits are at a new high.
But that they'll always keep on making high, no?
Similarly, markets will also follow that corporate profit, right? We never say GDP is at a new high. The everyday media doesn't write a headline that corporate profits today are at a new high. But because markets are tracked on a daily basis, that gets highlighted. Your Nifty profits 3 years back were 3.5 lakh crore, FY20. FY23 was 6.4.
Wow.
This year we are talking about 7.8 and FY25 8.7. Our own coverage universe, Motilal Oswal coverage universe of roughly 260 stocks, it will cross a profit pool of 10 trillion rupees in FY24. It was 8.4 trillion last year. So, we are talking about a very different scale of profits, Nikunj, today. The profit that Nifty made in FY20 will be made by just 11 financial companies in FY25. 3.5 lakh crore Nifty 50 made. FY25, 11 financial companies in Nifty will make a profit of 3 lakh crores.
Yeah, I mean, HDFC Bank after combined entity next 2 years is projected to cross 150, 160 lakh crore combined entity. So that's the kind of, we looked at Tata Steel numbers in the morning. So there is a lot happening. Yeah, why don't you take over?
No, I just had a follow-up. Now, since you're saying that, the returns on Nifty follow the corporate profits, and you're talking about how next couple of years is going to be very solid with respect to profitability, are you saying the next couple of years we are likely to see high teen kind of returns and not just the average return of around 13-14% at index?
Ideally, it should be, because if the current trend sustains, which is that Nifty follows the corporate profitability, and if you're talking about 20% growth this year, and about 15-16% growth next year, then ideally Nifty should give you similar returns, even if you don't assume any derating or re-rating, right? You just assume normalized circumstances, current PE sustains. Or look at it differently. Our EPS estimate for FY25 is 1140 rupees, right? Today you're talking about 20 times FY24 or 21 times FY24, which is 6 months later. If you were to extend a similar multiple 1 year down the line to FY25, so 1140 is the EPS, you apply a multiple of 20 times to that, you reach a number of somewhere about 22,800. Keep a margin of safety of 5-6% on EPS going wrong, or numbers not meeting expectations. You're still talking about 20,200 to 23,000 kind of a range. If this 1140 EPS is delivered and current PE multiples of somewhere about 20 sustains.
So you don't give a house view in terms of levels, but we have derived some levels from
It's
you.
a
That
very logical, mathematical
That's just the
derivation.
inference of what data is telling you. But let's get a bit sector specific and stock specific now. So which sectors do you think will lead this rally? And I ask you that because there is a very disparate view. Either be with the momentum and buy the sectors which have done well, or be in the under-owned sector or the sectors which haven't done well. Which way are you going?
So look at it this way, different sectors have contributed if you look at last 5 years. Sectors which were pariah 3 years back, metals, oil and gas, they've come back strongly in 2021 and 2022. Then pharma took a breather for 2 years. It made a huge comeback in the last 6 months. Now, which are the sectors which are taking breather? Your Nifty is at a new high. All large cap IT companies are down anywhere between 20 to 25% from their respective 2021 highs. Their valuations are very reasonable. You look at large cap banks, they've hardly participated. Whereas the profit pool of the BFSI companies which I mentioned has gone up 5 times in 5 years. 45,000 crores in FY18 to 2,12,000 crores in FY23. This year we are talking about a 2.5 lakh crore profit pool. Companies which were trading at 3.5-4 time price to book are now available at 2.5, 2.6. So these are two big sectors which I mentioned at the beginning also, which has not participated. Whereas sectors like industrials, capex, manufacturing, PLI, defense, all that bracket if you look at their combined market cap, and I was doing this exercise a month back, if you look at the top 1,000 market cap companies of India, sort them out in descending order, you filter out these companies belonging to industrials complex. There are 103 companies. Their combined market cap in July 2020 was 7 lakh crores. Today, that market cap is 23 lakh crores. Wow. And if you keep aside the top 10 companies there, the likes of L&T, NTPCs, the rest of the companies, which is below $3 billion market cap, they are up anywhere between 6, 15, 20x. Right? So a sector which for 10 years had not seen cycle, the last capex cycle you saw was in 2012. And every year people used to write report, including us, that this is a year of private capex, this is a year of private capex. It never used to happen. Suddenly it has happened in last 1.5 years, and it is obliterated the entire underperformance of previous decade. You look at their 5-year CAGR, 10-year CAGR returns now. Their 10-year CAGR returns are now 19-20%. So that is what 1.5 year of a cycle is done. And we are still at the beginning of that cycle. The order books are still building up. Execution is still building up, whether it is road, railways, defense. You hear it every day in your news stories. So I think there are 4 or 5 sectors which are together having a coordinated upcycle. And after many, many years, capex we just spoke about. You look at real estate. The upcycle is happening after 10 years. You look at hotels. The 2008 EBITDA of Indian hotels and 2018 EBITDA was same. Average EBITDA margin of 15%. They did 35% EBITDA margin in 2023. Right?
Very high.
Auto, I mentioned to you about banks' profitability going up 5x in 5 years. In that same 5-year period, auto profits were flat. 30,000 crores, 30,000 crores. We are expecting it to double in next 2 years. So auto is the 4th sector where upcycle is happening out of 5 years. And last but not the least is hospitals, where I don't remember when was the last time there was an upcycle, because we didn't have too many hospital companies listed. So there are 4 or 5 sectors where you're seeing an upcycle after a very long time, and all of them are domestic cyclicals with good tailwinds behind them. Right? There are big contributors to the index, real estate, hotel, auto, all of them put together may not be even 10% of the index today. But they have a long growth runway ahead of them.
Okay. Fundamentally, forget what will happen today, tomorrow. How would you analyze railways and defense as cycles? One is this entire big picture. Second is the companies and how they will gain. And third is valuation. So fundamentally, I'm sure everybody is trying to understand from you that what is the right way to understand the railway business and defense as a sector?
So Nikunj, you have to look at business and stock prices separately in this sector, because the stock prices have behaved very differently in the last 2 years. There can be a period of time where businesses scale up, execute, deliver returns, profitability, return ratios, everything. But stock prices may languish now. They will just flatten out, possibly for a period of a year or two. And I don't know when it will begin.
Both for railways and defense.
It is. Yeah.
You don't expect a fall. You don't expect a crack.
So that is a function of 2 things. One, how's this big macro election event plays out? Because all of these sectors, one of the biggest tailwinds behind them is the government policy momentum. Yeah. Right. If that sustains, then I don't expect a big crack. Okay. Stocks which have gone up 4x, 5x, a lot of these rail PSUs have gone up 4, 5x. So for them to correct 20-30%, I won't call it as a crack. It can happen in a blink of an eye. You saw last week, one fine day, they fell 10-15%. But the big crack is a function of 2 things. One is if the policy momentum disrupts in any way, irrespective of what is happening to their business, if there is a policy change, then the PE multiples can crash. Okay. Because they're end of the day government entities. Yeah. Their working capital balance sheets are very different because their biggest customer is government. Second, if for whatever reason the execution suffers, a lot of things have to fall in place for execution to materialize. So even if the policy momentum is supportive, but execution is not supportive and execution falls apart, then there is a possibility of a crack. Otherwise, if you see some disappointment here or there on quarterly numbers, you expected 100, they delivered 80 or 85, then, it is par for the course. Sometimes they will correct. Those who have felt left behind, they will jump in. But looks like the kind of numbers that we are talking about, and we had the advantage of Sudhanshu Mani, who is considered as the father of Vande Bharat Express, present at our conference last month. He was a key main track CEO track speaker. And he gave a lot of data points, how government is thinking, what kind of numbers they're talking about, kind of order books can be built, which all kind of different companies in different segments can benefit. So I think the path is very clear, just that you have to negotiate this big event which is happening 6 months down the line.
So I'll summarize our interaction today and just interrupt me if you think I'm not able to summarize it well. You're of the view that markets may be at an all-time high, valuations or not. The tailwind in the sector, in the big sectors, is good enough to ensure that a CAGR double-digit return next couple of years cannot be ruled out. There are big themes like capex, real estate, hotels, autos, hospitals, which are the new driving things. And if one is looking at one large profit pool, the delta will come in automobiles and it will come in private banks.
Yes.
Have I missed on anything?
Just one thing I wanted to re-emphasize. Within financials, the kind of change or delta that you are seeing in PSU banks' profitability is unforeseen.
Okay.
Right. Together, they made a 30,000 crore loss in FY18. In FY23, they made a profit of 1,10,000 crores.
Yes.
All the PSU banks that you're talking about, we are right now looking at 16 to 18% ROE. I don't remember when was the last time they delivered this kind of an
I met
ROE.
SBI chairman. You know what return on equity number he told me? I was surprised when he told me that they're north of 20%. SBI is equivalent, I mean, it's not equivalent to HDFC Bank, but HDFC Bank is 23-24%.
17%.
SBI is north of 20.
Possible, quite possible, because...
And he says I can build on it.
Yeah.
I mean, I'll send you the link of that interview in case you missed it. But I mean, he was bullish, he was confident, and he was charged up.
It's the single largest active overweight in our model portfolio. Our single largest overweight sector is PSU Bank for last 2 years now.
No, have a look at the interview. I mean, overweight could be double overweight after that. Really appreciate your time. Thank you for dropping to the studio. First time actually interacting in the studio. So we must make this as an habit.
Sure.
Okay, Rohan Verma joins us now. And before I go to Rohan Verma, Rohan, I'm just coming right to you. Want to mark the markets, just what we've been discussing. We'd had a fantastic interview with Gautam and Atul, but I want to mark Reliance Jio. I want to mark some other stocks in terms of what's happening in the PSU banking space and what's happening in terms of some of the pharma names. So it's like a steady market, nothing here, nothing there kind of a market. Rohan, I've been speaking to some common friends who are big investors in your company. They are of the view that MapMy India is at a multi-year cusp of exponential growth. What has changed in last 6 months that markets are deriving this kind of confidence?
Hi, Nikunj. Thanks for having me on your show. I think probably, we're a new type of company. We're a deep tech products and platforms, digital map-based company. And it probably took a little bit of time for both the markets to understand as well as for us to explain what are the different use cases and growth vectors for the company. And in June, really, we did the Analyst and Investor Day, where we tried to go into detail of, and we've put that on the stock exchange as well, as to what are the different use cases, what is the revenue model for different sectors, automotive, mobility, corporates, enterprises. And really the other thing that has come to bear in this last few months especially is how the consumer app of MapMy India, the Mapples app, has really just taken off, as even consumers now are getting to know how much better our maps are from a feature capability, technology capability, and also hyper-localness. And I think combination of those things, as well as the growth of our IoT business, which itself has a very large addressable market, probably those are the things that have contributed to a better understanding and better confidence in the market.
At your business, I mean, we are used to looking at IT companies over the years, quarter on quarter. That is how you look at them. If quarter on quarter they don't grow, that means business is bad. Quarter on quarter they grow, that means company is in a linear manner. But with MapMy India, there is a lot of seasonality in your business. Is that the nature of the business?
Yeah, that's true. I mean, since the beginning, we've tried to communicate that look at us as a year-to-date, year-on-year business. Don't look at us one quarter from the next, because the order book is such that the revenues might be lumpy. And if you look at our performance, fiscal performance, I think both growth has been there around 40% and also margins have been there. EBITDA margins have been there around 40% plus and PAT margins have been 30% plus. So I'd say strong financial performance, but yeah, not something to look at quarter on quarter, but year to date, year on year. And I think that we are tracking.
Given the fact that the government is going to make the Make in India GPS alternative mandatory for all smartphones and the date mandated is December 25, what kind of revenue potential is expected from this? And I want to understand how the company could potentially benefit.
Sure, thanks a lot for the question. Actually, if you saw the G20 event which was a very, very big thing in the last, that happened 10 days ago. MapMyIndia played a critical role during the G20. In fact, you had the Delhi police putting out many, many advisories, both on video and TV, on radio, as well as print, telling people to download and use the Mappls MapMyIndia app because it would provide accurate navigation as per the official traffic advisories. Now, this was a very complex traffic planning, route planning, VIP movement, as well as citizen traffic management exercise. And we worked very closely with the Delhi police over the last 4-5 months to make sure that our maps and our technology and our IoT devices could be used for citizen facing, as well as for the authorities which were planning and the VIP movements. And probably that was one good showcase of indigenous technology with a focus on solving for India. And this is the same thing that applies for Navik, which is Indian subcontinent focused satellite positioning technology, which MapMyIndia takes full advantage of. We sell a lot of IoT devices which are powered by Navik, and our app is in fact compatible with Navik. We worked with ISRO over the last, 4 years ago, to build a Navik app specifically for fishermen to help them from going beyond the maritime border and getting cyclone alerts and also information as to where potential fishing zones are. So we understand the value of Navik. We work very closely with ISRO. We are very thankful to their support and to their guidance. Now, as the government is focusing on self-reliance in this geospatial sector, with Navik on the chipset side and the satellite side, it is kind of obvious that maps and map-based technology also the government will want to be self-reliant for, so that it can solve the problems of Indians, irrespective of whether foreign players are there or not. So although there's no specific number I can tell you, but these tailwinds are definitely towards the indigenous products and platforms companies such as ours. And we're obviously the leader in this space. So we're excited about this, happy that government as well as other large players are kind of coming together towards these indigenous solutions.
So let's talk about the consumer interface. Google is for free, but I'm sure MapMyIndia cannot be for free for long, because ultimately that is your main product. How would you be looking at expanding in the consumer space when you, let's say, have to compete with a Google Maps or anything from, anything which is free?
Nikunj, I would love for you to use our Mappls app. I think that would be a great champion for us. You'll find that when you use the app, when you're coming to a flyover, Mappls app will show you in 3D that you have to climb the flyover or stay below. Whereas in Google, it's two squiggly lines and it's very confusing where you have to navigate to. It leads to a lot of loss of time, kind of unsafe situations as well. Our consumer app is actually free. It's doing quite well. In fact, it reached the top of the App Store rankings above Google Maps. We do monetize on the consumer side in different ways. For now, we provide Mappls gadgets, which are dash cameras in your car, GPS trackers in your car, and infotainment systems in your car, so that you can remotely monitor video of the car or GPS movement, and you pay a subscription. But the Mappls app that is totally free. And we, of course, have a healthy B2B and B2B2C business to automotive OEMs, corporates, government, tech players, etc. So overall, companies in a strong financial position, we're able to kind of offer a free solution that gives to consumers what they want, and it complements our paid solutions business.
And this is the last reported data we have, that you have an order book of 500 crore and you're looking at revenue of 1000 crore by FY28. How will this translate into the revenue curve for you?
Got it. Nikunj, our open order book at the end of FY23 was 900 crores. It grew from 699 crores to 918 crores. Revenue was 282 crores FY23, growing at 35 to 40% CAGR last few years. And so we've put out in our analyst day, investor day, about how we see different growth vectors. In automotive, volume growing 3x, in IoT volume, in fact, growing 10x. It grew 140% the previous year, in fact. And in corporate and government, it growing 4x, 6x, etc. So we see this 40% growth happening in the next 4-5 years. The addressable market, just specific to our solutions and the way we're looking at it bottoms up, is about 8,700 crores. So there getting to 1,000 crores is something we are confident on. We are working towards. Of course, it's a 4-5 year journey. So people will see this unfold in the time to come.
One more follow-up question. What is the upside risk to your assumption? Because suddenly sectors like defense are scaling up. Suddenly navigation and crop mapping is picking up. So is there upside risk to your guidance?
Yeah, I mean, if you look at the opportunities for a company like MapMyIndia, which is the core largest mapping player, map data product player, was probably the strongest IoT player in the country today, and which where we are deeply investing in the drone sector. Each of these three have very, very large potential. And then we are well placed in the defense sector. I mean, MapMyIndia is doing business with the defense, and you can tell that we are the indigenous company. So we see potentially lots of opportunity additionally, and as well as the international market is ahead of us, which we've not talked about before, and the consumer opportunity is ahead of us, which we've not talked about before. So in that sense, we have a lot of optimism, but the focus of the Analyst Investor Day was to give a sense of realism that, based on the current market and the way that we are going about executing our B2B, B2B2C business with our current portfolio of products, this is the kind of growth that we are, aiming for. Anything upside, we'd be happy to take on that. We are well positioned with 500 crores of cash sitting in the company and generating about 100 crores of cash every year. So that way, the company is well positioned to capture upside opportunities. But focus is right now to kind of execute, ensure that we bank the execution towards quarterly and yearly performance.
Thanks for joining in and giving us a lot more clarity on the business and your news triggers going down the line. All right, a quick look at the buzzers in trade today. IOB flexing its muscles, so a solid 10% being piled on. Take a look at something like a UCO Bank within that same basket. Bank of Maharashtra has scaled up something like 5% plus. You've got a PNB, which is looking good. Bank of India, Indian Bank. IDBI Bank, pretty much put your finger on any of these names and they're all active in today's trading session. All right, let's move away from that and focus in on Satin Credit Care. Lots to talk about with respect to their asset quality, what the view is when it comes to their net interest margins, and where they are likely to see growth. HB Singh is the chairman and managing director now joining us. Thanks much for taking time out. Now, Mr. Singh, you managed to post a growth of 26% on a year-on-year basis in Q1, which is traditionally a weak quarter. Given the fact that we've got the upcoming festive season, the kind of traction that we're expecting, do you think that a 25% plus growth target that has been outlined is a bit conservative? Would you revisit that?
So I think, we gave a guidance at the early start of the year. For us, I think the idea was that, we could post a growth of about 25%. But, this is 25% plus, Our viewpoint is that since the first quarter went out very well, we expect that we will technically outgrow the guidance which we have given. But, to be very conservative and to be very safe, we've given a 25% plus growth target for this year.
Okay, so being realistic there, but nonetheless, there are levers available to kind of beat the guidance of around 25%. But talk to me, where is this growth coming from? Is it a specific, geography which is doing well for you? Or is it a specific vertical in terms of, let's say, rural or SMEs or something which is doing exceptionally well?
So we are predominantly rural, so if you look at a complete AU, this is consisting of about 80%, which is rural. So the rural economy is doing well with probably normal rainfall and normal monsoon being there. The Kharif sowing crops and everything, probably boding well in terms of the demand for consumption as well as for productivity growth, which is there, and the income levels have probably been stable. In fact, they are slightly rising in the rural space. That is one. And the other factor is that for us, in terms of microfinance, I think, the kind of penetration still in the states where we operate is still pretty low. So that actually gives us a pent-up demand in terms of increasing our footprints in these geographies wherever we are present. So I think, that these are two factors which will contribute towards this kind of a growth.
So rural as well as increased penetration, these are the two levers. But does it mean that going forward, your quarterly disbursement rate could be higher than 2,000 crores?
It could possibly be. That's what I said. First quarter being a weak quarter, the fourth quarter, the third and the fourth quarter is always a very, very strong quarter. We hope that we will be able to beat the guidance which we've given.
Okay, fair enough. Give us a sense as well going down the line as to what the outlook is when it comes to your ROA on an annualized basis, because that came in above the stated guidance of about 3.4 to 4%. Your cost to income ratio as well has improved. Given that you're focusing on improving your operational efficiency, what's the outlook?
So we've given an outlook technically based on the average which was there for the last year, for this year was about 3.66%. And we've given again a guidance of 3.5%. But definitely, looking at the way we are able to surpass our growth figures, I think we'll be able to surpass our ROA figures also. Having said that, the reason why we feel that we are pretty confident in terms of when we did our analyst day meet, we are very confident because of the pent-up demand, because of the asset quality being much better than what we really expected. And possibly also the fact is that whatever had happened during the pandemic, I think that is all over now. We made all write-offs and provisions, and we have nothing more to practically look at in terms of stability. And once all these factors start kicking in, our cost to income ratios as well as ROAs, everything will have a positive impact in terms of whatever guidance we've given.
Okay, I just wanted to highlight that specific issue since you're talking about write-offs and collections and all of that. Could you provide us a status update on the Assam historical collections that you were about to receive from the government? Because we understand they had been a bit delayed and you were expecting the first tranche. Has it happened?
See, the data has already been given to the state government. In fact, the state government has also cleared up that data along with us, along with the self-regulatory organization MFIN with us. We were expecting that this first tranche would probably come in. We are very hopeful, and there are signs which are coming in from the state government that this will happen pretty soon. My guess is that looking at it, I think we feel that in the next week or so, we'll get the first tranche, which is going to probably come in as possibly a boost to our bottom line and to get the money back from the state government. So we're very, very hopeful within this week or maybe another 10 days we'll be able to get the money, first tranche money coming in.
Be the quantum of that first tranche?
I think I'm not very clear about the figure, but this will be close to about, I think, 10 to 15 crores, which will come in the first tranche.
Okay. I just want to understand one simple, assessment of how do you see the unsecured space moving up. We are looking at stress in the rural economy. Two-wheeler sales are not there. Erratic monsoons are there. Inflation is coming higher. Yet every NBFC and bank is looking at increasing the MFI loans or perhaps their unsecured book. Isn't that too risky looking at the backdrop of the economy where the recovery has been K-shaped?
Yeah, I think we will have to look at possibly a few factors which define microfinance. So microfinance is an unsecured loan, but definitely the way this is operated, it is a joint liability. It's a group model, So there is a difference between an individual lending model and a group model. In a group model, definitely yes, you're looking at peer collateral in terms of the businesses probably or the borrowers probably standing in for each other to repay any kind of a delay in an installment. And that's one, The second factor, I think, which is probably to be looked at, this is income generating loans. This is different from probably an FMCG or maybe a two-wheeler demand which comes up. That's an aspirational value for maybe the rural economy to really look at. Aspirational in whatever degree sense you would probably look at. This is income generating loans. These will actually boost up the income levels of our borrower. Now, these are definitely in demand. This actually helps the borrower to increase their income or their productive capacity. So over here, the demand is there. The capacity to repay, it's been erratic, definitely yes, but it's not been that, we are looking at a drought situation or anything, I think, all the kharif sowing crops as well as everything is probably moving in the right direction. So our sense is that yes, definitely stability is there, and we are hopeful for our growth as well as the asset quality which is going to come in.
Hopeful about asset quality, growth as well. So that's the take coming in. Thank you so much for making time and speaking with us. Appreciate you joining us. So expecting perhaps 10-15 crore as the first tranche to come by as far as those Assam collections are concerned. Looking at beating their guidance of 25% AUM growth and penetration, as well as the shape up of the rural economy, something that is going to do well for them. But a quick programming note, we at Times Network bring you the Mirror Now Summit Chhattisgarh, which will be held on Wednesday 20th in Raipur. As India's most influential news network, Times Network channels have been a catalyst for change and action for better India. With the theme Path to Progress, we aim to showcase the journey that is leading the change in the sustainable agriculture revolution and enhancing farming methods for economic growth. Chhattisgarh's commitment to enhancing healthcare is evident with a focus on accessible, high-quality medical services for a healthier future. At the Mirror Now Summit, we will discuss and deliberate with state leaders and authorities to define a holistic development agenda. So get ready to catch all the action right here on the Times Network.